Welcome to Reporting Matters, where we explore the world of corporate accounting. This episode is presented by Artificial Intelligence hosts and is for educational purposes only. For our full disclaimer, stay tuned until the end of the show. Let's dive in.
This is Reporting Matters. The Corporate Accounting Podcast starts now.
So imagine you walk into a store in Amsterdam, you grab a coffee, and, you pay €4.
Right, standard transaction.
Exactly. And that price is a fixed objective reality. It's printed on the menu, it's printed on your receipt, and it's just this permanent record of value that no one really questions.
No, of course not. I mean, you wouldn't haggle over a latte.
Right. But for the massive multinational corporation that actually owns that cafe, the price they pay for their own coffee beans or their software or their internal management structure, it is an entirely malleable billion-dollar fiction.
Oh, absolutely. It is. It's the absolute definition of a financial gray area.
Yeah, we are basically looking at a financial landscape where the price tag is effectively blank and the rules of the game are written in pencil.
Well, because when you remove the natural friction of the open market, you are left with a system that requires a completely different, highly scrutinized rule book.
And today, our mission is to decode that exact rule book for you. We are doing a deep dive into the complex, incredibly high-stakes world of Dutch transfer pricing rules for international corporations based in Amsterdam.
It is a massive topic.
It really is. We're pulling our insights today from a technical guide titled Dutch Transfer Pricing Rules Explained. And look, I know that a phrase like corporate tax compliance might sound like it belongs in a dusty filing cabinet.
It definitely sounds dry on the surface.
Yeah, but this is actually a ruthless, high-stakes chess match. I mean, it involves global supply chains, international law, and the strict, unblinking gaze of the Dutch tax authorities.
And the penalties for losing that chess match are staggering.
Right. One wrong move on paper doesn't just result in a little slap on the wrist or a fine. It can literally cost a company hundreds of millions of euros and completely unravel their global financial strategy.
Easily.
But before we get into the heavy weeds of compliance tiers, specific tax acts, and global minimums, let's just establish the baseline for you. What exactly is transfer pricing?
Yeah, so to understand transfer pricing, we first have to establish the baseline of how normal business works, right? Which is rooted in standard market forces.
Okay, simple supply and demand.
Exactly. When entirely separate, independent businesses buy and sell goods or services from each other, there is this natural adversarial friction.
Right, they aren't friends.
No. The seller wants to maximize their profit, so they push the price as high as possible, and the buyer wants to minimize their costs, so they negotiate the price down.
Makes sense.
And where they eventually meet in the middle, that is considered the fair market value. This natural friction dictates the price.
Okay, let's unpack this with a really simple analogy. If you sell a car to a total stranger, you are going to fight for top dollar.
You want every penny.
Right. But if you sell that exact same car to your little sister, you might sell it for $1.
Sure, out of love.
Exactly. The actual inherent value of the car hasn't changed at all. It's the same engine, same tires, but the price changed radically because of your relationship. The friction just disappeared. So, is this essentially what multinational companies are doing across borders?
That is the exact dynamic, yes.
Yeah.
Just scaled up to a massive corporate level. The source text gives a really clear example of this.
Oh, yeah, the German company.
Right. Imagine a large parent company headquartered in Germany, and they have an affiliate office located down in Amsterdam.
Okay.
So the German parent company provides, let's say, management services to the Amsterdam office. Or maybe they license a proprietary software system for the Amsterdam office to use for their daily operations.
And because they are part of the exact same corporate family, they don't negotiate like strangers.
Precisely. Because they are the same corporate entity just wearing different hats in different countries,
right,
there is zero natural market friction.
Right.
The German parent and the Dutch affiliate can sit in a boardroom and basically arbitrarily set whatever internal price they want for those services or that software.
It's just moving money around.
Yes. And that internal pricing mechanism, the price they choose to charge themselves, is what we call transfer pricing.
Okay, so wait. If it's all the same company's money, right? It's just moving from their left pocket in Germany to their right pocket in Amsterdam. Why does the price on the invoice even matter?
It matters immensely because of the underlying motive, which is taxes.
Always comes down to tax.
Always. Every sovereign nation sets its own corporate tax rate.
Yeah.
So the primary objective of multinational corporations when they manipulate these internal prices, it isn't administrative. It's to artificially shift profits out of jurisdictions where taxes are very high and funnel those profits into countries where taxes are much lower.
Okay, let's put some numbers to this so you can really see the mechanics. Let's say the corporate tax rate in Germany is around 30%, but in the Netherlands, it's closer to 25.8%.
Right.
So if I'm the CFO of this global group, I want my profits sitting in Amsterdam, not Frankfurt.
Exactly. You want to pay 25.8, not 30. So how do you get the money there without actually doing more real physical business in Amsterdam?
You tweak the transfer price.
You tweak the price. You have the Amsterdam affiliate charge the German parent an exorbitant fee for, say, logistical consulting.
Just a made-up service, basically.
Or a highly inflated one. Suddenly, millions of euros in cash move from Germany to Amsterdam just to pay that internal invoice.
Wow.
And Germany registers a massive expense, which lowers their taxable profit in that high 30% tax bracket, while Amsterdam registers massive income, which is taxed at the lower 25.8% rate.
That is wild. You haven't sold a single extra product to a real customer.
No.
But you've just saved the company millions in global taxes just by moving paper.
Which means Germany just lost out on tax revenue that they rightfully should have collected on the economic activity happening within their borders.
And I imagine companies will do the exact opposite too, right? To pull money out of the Netherlands if they have a subsidiary in a jurisdiction with like a 0% tax rate.
Oh, absolutely. This is why tax authorities globally are watching this practice with incredible intensity.
And for you, as an Amsterdam-based corporation, the watchdog you need to worry about is the Dutch tax authorities.
Yes, they are very vigilant.
They are the ones monitoring these internal transactions. I mean, they know exactly how this profit-shifting game is played, and they are actively looking for companies trying to artificially drain taxable profits out of the Netherlands through inflated or deflated internal invoices.
They are highly sophisticated. They aren't just looking at the final number on your tax return, They are analyzing the exact mechanics and the internal economic logic of how you arrived at those numbers.
So this creates a massive philosophical and practical problem, doesn't it?
It does.
Because you have multinational companies that fundamentally need to do business with their own foreign affiliates just to operate efficiently. But they operate in an internal market completely devoid of natural supply and demand. So how does the Netherlands actually enforce fairness in a market where the natural friction of capitalism simply doesn't exist?
Well, the answer to that lies in what is considered the absolute bedrock of the entire Dutch transfer pricing system. It is a concept called the arm's length principle.
The arm's length principle. This is like the golden rule of the whole system.
It is the golden rule, and it essentially demands a grand hypothetical.
A hypothetical.
Yeah. It dictates that any transactions, whether they are cross-border or even domestic between related parties within a corporate group, they must be priced exactly as if they were entirely independent third parties operating under identical market conditions.
Okay, so the law is literally telling you, pretend you don't know each other.
Yes.
You must maintain an arm's length distance in your pricing, treating your own subsidiary with the same strict commercial terms you would apply to a ruthless competitor or like an unknown vendor.
That is the exact mental framework required. And, this isn't just a friendly guideline or a best practice suggestion from an accounting board.
It's an actual law.
The text makes it very clear. This principle is legally codified in the Netherlands. It sits squarely under Article 8b of the Dutch Corporate Income Tax Act. It is hard law.
Let me push back on this, though, because a law is really only as good as its enforcement, right?
Sure.
What if a company just ignores Article 8b? Let's say they give their Amsterdam subsidiary a massive family discount on wholesale goods to keep the local profits artificially high, or they overcharge them massively for management fees to drain the profits out. What is the actual tangible consequence if they get caught deviating from this arm's length principle?
The consequences laid out in the guide are severe, and they are immediate.
Okay.
If the Dutch tax authorities audit you and determine that the commercial or financial conditions agreed upon in your internal transactions deviate from what independent parties would have accepted, they do not just issue a warning.
They don't just say, hey, fix this for next year.
No, absolutely not. They will forcibly adjust and recalculate your Dutch taxable profits as if market standard terms were applied.
Wow, they just rewrite your math.
They entirely rewrite your math. They will sit down and say, you claimed 10 million in expenses for this software license, but an independent company would have only paid 2 million. So we are disallowing 8 million of your expenses.
Ouch.
Yeah. This artificially inflates your taxable profit by 8 million euros right then and there, resulting in a massive unexpected tax bill plus potential penalties and interest for non-compliance.
So they effectively nullify your internal pricing agreement and impose the market reality upon you retroactively?
Exactly. They enforce the hypothetical.
But here's where it gets really interesting, I think. Because if I am a global CFO, my first thought is, okay, the Dutch have their own strict rules under Article 8b. Now I have to hire a whole team of local experts to learn the specific, highly idiosyncratic Dutch way of calculating a fair price.
That would be a nightmare.
Right. But the source text explicitly highlights that the Netherlands actually doesn't try to reinvent the wheel here with unique domestic deviations.
That is a crucial point for international businesses to understand. The Dutch framework fully incorporates standard international best practices. Specifically, the OECD Transfer Pricing Guidelines.
To OECD.
Yeah, the Organization for Economic Cooperation and Development. They have spent decades establishing the global gold standard for how to calculate these hypothetical arm's-length prices.
So they already did all the heavy lifting.
Exactly. By adopting these guidelines directly into their enforcement of Article 8b, the Netherlands makes it so that if a company is strictly compliant with global OECD standards, they are largely compliant with Dutch standards.
That makes things a lot easier.
It creates a cohesive international tax environment rather than a localized regulatory trap.
But that brings up the million-dollar question for you. How do you actually prove it?
The proof.
Right. Because it's one thing to philosophically say, oh yeah, we charged a fair market price. But how do you mathematically prove a hypothetical scenario to a skeptical tax inspector?
Well, the OECD provides a specific mathematical toolkit for this. The text details that companies actually have total freedom to choose any of the 5 standard OECD pricing methods. For example, they explicitly named the comparable uncontrolled price method or the CUP method.
Okay, let me challenge the practicality of this. The CUP method, from what I understand, involves finding an exact replica of the transaction in the open market.
Right.
You have to find a transaction where you sold the exact same product under the exact same conditions to an independent third party and use that exact price.
Yes, that's the idea.
But let's go back to our German parent company. What if they developed a completely proprietary, one-of-a-kind, AI-driven logistics software that they licensed to the Amsterdam branch?
Okay.
There is no independent market equivalent. They don't sell it to anyone else. So aren't these OECD methods just educated guessing games disguised as math?
Your challenge highlights exactly why there are 5 methods and not just one.
Oh, I see.
Yeah, the CUP method is the most direct. And if you are selling a commodity like a specific grade of crude oil or thousands of identical microchips, it works perfectly because public market prices exist.
You can just look up the price of crude oil.
Exactly. But you're absolutely right. For highly specific corporate services, unique intellectual property, or bespoke proprietary software, like your example, the CUP method completely falls apart. You cannot compare the incomparable.
So what does the company do then? They can't just throw their hands up and say, well, it's impossible to price, sorry.
No, they move down the toolkit to other methods. The text mentions the cost-plus method, for instance.
Cost-plus, how does that work?
In your software example, the company would look at the exact base costs incurred by the German parent to develop and maintain that software for the Amsterdam branch.
So like the salaries of the coders, the server costs, the overhead.
Precisely. Then they would conduct an economic study to find out what kind of profit markup independent software development firms typically apply to their costs. So if independent firms charge cost plus a 15% markup, the German parent applies that exact 15% markup to their internal costs to determine the transfer price.
So you are benchmarking the margin, not the product itself.
Exactly. You are comparing the profitability of the function. And the most common method used globally, which the text also explicitly names, is the transactional net margin method, or TNMM.
TNMM.
Right. Instead of looking at gross markups, TNMM looks at the net operating profit margins of similar independent companies.
Can you give an example of that?
Sure. If you are an Amsterdam distribution subsidiary, you might not be able to find independent distributors selling the exact same unique products you sell. But you can find a data set of independent European distributors and analyze their net operating margins.
Just general distributors.
Yeah, and if they all operate at a 3% to 5% net margin, you set your internal transfer prices so that your Amsterdam branch mathematically lands right in the middle of that 3 to 5% range.
Okay, so as a corporation, I have total freedom to pick my weapon from that OECD toolkit. I can use CUP, cost plus, TNMM, whatever gets the job done.
Well, you have freedom, but there is a massive caveat to that choice.
There's always a catch.
Always. The text emphasizes a critical condition. The company must select the method that generates the most reliable arm's-length result for their specific business setup.
Meaning I can't just run the math on all 5 methods, figure out which one lowers my Dutch tax bill the most, and pick that one.
Exactly. You can't just cherry-pick the method that gives you the best tax outcome. You have to be able to logically and economically defend why the method you chose is the most sound, scientifically valid way to measure your specific transaction based on the availability of data and the nature of your business.
So you have to show your work.
Yes. If you use TNMM, but the tax inspector proves that a perfect CUP existed and you just ignored it because it gave you a worse tax result, they will invalidate your entire calculation.
Wow. Okay, so the rule is conceptually clear. Act like strangers. Use the OECD tools to calculate the price based on margins or comparables, and don't cheat the math.
Right.
But actually proving you followed this grand hypothetical, I mean, that must require a massive verifiable paper trail. You can't just walk into an audit, shake the inspector's hand and say, trust me, we use the cost plus method and applied a 15% markup. It's totally fair.
No. Handshakes do not work in transfer pricing.
Right. This leads us perfectly into how the Dutch tax authorities enforce this through documentation and how those requirements actually scale dynamically depending on how big of a player you are.
Yeah, if we connect this to the bigger picture, the documentation rules are where the abstract philosophy of the arm's length principle becomes a very tangible, very heavy administrative burden.
The paperwork.
The paperwork. And as the source material points out, the exact compliance requirements for an Amsterdam-based corporation scale on a dynamic tiered system.
Okay.
It is entirely based on the corporate group's global consolidated revenue or turnover from the preceding fiscal year.
Right, so it's a sliding scale. The Dutch tax authorities recognize that a small local software startup that just opened its first foreign office shouldn't have the same crushing paperwork burden as a massive, established global automotive manufacturer.
Exactly. It has to be proportional.
So let's break down these tiers in detail for you, starting from the bottom. Tier 1, small to medium groups. This is for corporate groups with a global consolidated turnover of under 50 million euros. What is required of them?
For this tier, the guide outlines that companies are subject to a general documentation requirement.
Which, as a business owner, sounds suspiciously vague. General documentation?
Well, it is intentionally less prescriptive than the higher tiers. The text notes there is no rigid, legally mandated format you have to fill out. There is no specific form to download.
But it's not a free pass.
Oh, absolutely not. The guide makes it very clear that this is not a free pass to do nothing.
Right, you can't just have a napkin with some math scrawled on it sitting in a drawer. The source says your administration must contain enough functional analysis and data to prove how internal prices were calculated and why they reflect market realities.
Exactly.
I want to drill down into that term, functional analysis. Let me ask you to speculate on this for a second. What might a functional analysis practically look like for, say, a small Amsterdam-based marketing affiliate that does work for a parent company in London? How do they prove their worth on paper?
That's a great example. A functional analysis, even in a free-form Tier 1 format, has to tell the complete economic story of the transaction by breaking it down into 3 distinct pillars: functions, assets, and risks.
Functions, assets, and risks. FO.
Yes, often referred to as a FO analysis.
Okay, let's apply that to the marketing affiliate.
So for that Amsterdam marketing affiliate, the documentation would need to clearly map out what functions the Amsterdam team is actually performing.
Like their day-to-day tasks.
Right. Are they just mindlessly executing a digital strategy handed down by executives in London? Or are the Amsterdam employees actually conducting the market research, designing the creative campaigns, and buying the ad space themselves?
Okay, that's the functions. What about assets?
What assets are they using to perform those functions? Do they own the proprietary marketing software, or are they logging into London servers? Do they own the brand trademark they are promoting locally?
And risks, because you mentioned that's a pillar too.
And this is often the most critical component.
Yeah.
Who bears the risk? if a €1 million marketing campaign completely fails and generates 0 leads.
Right, someone has to eat that cost.
Exactly. If the Amsterdam affiliate is just guaranteed a flat hourly rate from London, regardless of the campaign's success, they bear no risk. But if the Amsterdam affiliate's compensation is tied directly to the sales generated by their specific campaign, they are bearing significant market risk.
So how does this FDR analysis connect back to the price they charge?
By documenting the functions, assets, and risks, the company can then justify the margin they charge.
Okay, I think I see where this is going.
Yeah, if the Amsterdam office is just executing orders using London software and taking 0 risk, they should only earn a very small, routine profit margin, say, cost plus 5%.
Because they aren't bringing that much unique value to the table.
Exactly. But if they are designing the strategy, using their own unique algorithms, and taking on the financial risk of failure, they should earn a much higher entrepreneurial return, maybe cost plus 20%.
Wow, quite a difference.
Huge difference. The Tier 1 functional analysis has to map out that reality and prove that an independent marketing agency performing those exact same functions with those exact same assets and risks would charge that exact same price. It requires real, defendable economic logic, even without a standardized government form.
Okay, so that's the baseline. It's flexible, but it requires rigorous economic storytelling. But once your corporate group grows and crosses that €50 million global revenue threshold, the training wheels come off completely. We enter Tier 2, large groups.
Yes, the large groups.
This applies to companies with global revenues between 50 million and 750 million euros. What happens at this level?
At this tier, the ambiguity and flexibility completely disappear. The Dutch tax authorities legally require a standardized, highly structured 2-tier documentation system. You must maintain 2 specific documents, the master file and the local file.
Let's unpack these because from my reading of the source, they serve very different masters. Let's start with the master file. What is the master file actually looking for?
Well, the master file is exactly what it sounds like. It is a high-level, comprehensive, organizational overview of the entire global corporate group.
The whole thing?
The whole thing. It is designed to give the tax authorities a bird's-eye view of how the multinational machine operates. The authorities want to see your global business model. They want a written explanation of the main drivers of your profit. They need detailed visual maps of your global supply chains for your top products.
It honestly sounds like an investor pitch deck, but for tax auditors.
In a way, yes, but far more detailed regarding value creation. Crucially, the master file requires a deep dive into where your valuable intellectual property and intangibles are legally held and developed.
Patents, trademarks, that kind of thing.
Exactly. It also requires a full explanation of how your centralized financing arrangements work, where the group borrows money globally, and how that money is distributed among the affiliates. It's the absolute big picture of the global operation.
Okay, so that's the master file. And the local file, how does that differ?
The local file zooms all the way in. If the master file is the telescope, the local file is the microscope.
Oh, I like that.
It focuses explicitly and exclusively on the local Amsterdam entity. It requires detailed, itemized descriptions of all specific intercompany transactions involving that Amsterdam office.
Just the stuff happening locally.
Right. It requires highly specific local financial data, tying the transfer pricing calculations directly back to the local statutory financial statements.
So this is where the math actually happens.
Exactly. This is where the rubber meets the road. The local file must contain rigorous economic benchmarking analyses. You have to provide the hard data usually pulled from massive financial databases like Amadeus or Orbis to validate that the specific pricing your Amsterdam office is using mathematically matches the benchmarks of comparable independent companies operating within the European market.
It sounds exhausting.
It is. You have to show your search strategy, the companies you rejected, the companies you accepted, and the interquartile range of their profit margins.
Okay, let me push back here as a hypothetical business owner because this seems incredibly intrusive. Let's say I am just the director running the local Amsterdam office of a medium-sized manufacturing group.
Sure.
I'm just trying to hit my quarterly production targets and, manage my local staff. Why am I legally required by the Dutch government to maintain this massive, sprawling document, the master file, that details the entire global supply chain, IP holdings located in Bermuda, and centralized financing operations run out of New York?
It feels like overkill.
It really does. Why do the Dutch tax authorities care about the rest of the world if they are only taxing the profit generated in Amsterdam?
This raises an incredibly important question, and it goes to the absolute heart of how tax authorities investigate transfer pricing globally. The Dutch tax authorities cannot accurately assess whether your Amsterdam profits are fair if they don't understand the entire global board.
But why not? If they have the local file with the local math, shouldn't that be enough?
Think of it like looking at a single puzzle piece.
Okay.
You can examine the shape and color of that one piece all day long, but you can't tell if it's in the right spot unless you look at the picture on the front of the box. If the authorities only looked at the local file, a company could easily craft a very convincing, isolated narrative. They could hide the fact that all the real risk, the crucial patents, and the global branding are being hoarded in a zero tax haven, while the Amsterdam office is doing all the heavy lifting, the R&D, the marketing, the sales, but only getting paid a tiny routine return.
Because the local file just says, we act as a routine distributor and earn a 3% margin, which is normal for distributors.
Exactly. The local file looks perfectly clean in isolation, but the master file exposes the global reality. The master file reveals that the Amsterdam office is the only entity with actual employees, while the tax haven entity hoarding all the profits has 0 employees and just a brass plate on a door.
Oh, wow.
Yeah. The master file gives the authorities the context required to spot these sophisticated global profit-shifting strategies that are directly impacting the local Dutch tax base.
They need to see the whole chessboard to understand the specific move you just made in Amsterdam.
Precisely. They need to ensure the local economic reality presented in the local file perfectly aligns with the global narrative presented in the master file. If there is a disconnect, if you claim in the master file that R&D drives all your value, but the R&D is done in Amsterdam and the profits are booked in Ireland, the authorities will immediately target that transaction.
Okay, that makes complete sense. The master file prevents you from lying by omission. So that is Tier 2, which covers the vast majority of significant international businesses. But there is an even higher level, like an apex predator tier.
Yes, there is.
Tier 3, very large multinational groups. This is for the true corporate titans, groups with a global consolidated revenue of over 750 million euros.
What is the ultimate tier of compliance for these giants?
For these mega corporations, the compliance burden becomes monumental. They must maintain the master file, they must maintain the local file, and they are hit with a third, incredibly demanding tier of compliance. Country-by-country reporting, or CBCR.
Country-by-country reporting. What exactly goes into this report? Because from my reading of the source text, it lists out some pretty staggering, almost unbelievable data requirements.
It requires an unprecedented level of global data collection and consolidation. The corporate group must submit an annual report outlining the global distribution of their income.
Okay, income, sure. But it doesn't stop at high-level income. They must break down the exact amount of taxes actually paid, the specific economic activities taking place, the stated capital, the accumulated earnings, and crucially, the exact employee headcount across every single tax jurisdiction where the corporate group operates worldwide.
Let me make sure I understand the gravity of this. Every single jurisdiction. So if a massive tech giant has 50,000 employees in the US, 5,000 in the Netherlands, but they have a tiny 3-person office in a Caribbean tax haven, that 3-person headcount, the exact revenue generated there, and the exact taxes paid there have to be explicitly listed on this report submitted to the authorities.
Yes. Line by line, country by country.
How does a multinational corporation even gather, consolidate, and format this immense amount of data?
Right.
I mean, you were talking about operations spanning 100 jurisdictions, all using different local accounting standards, dealing with different currency exchange rates, and facing different local privacy laws regarding employee data. It sounds like an absolute logistical nightmare just to build the report.
Oh, it is a massive undertaking that often requires entirely new software systems and dedicated compliance teams. They have to pull data from multiple different enterprise resource planning or ERP systems. They have to map local charts of accounts back to a single global standard.
Yeah.
They have to reconcile intercompany transactions so they aren't double counting revenue.
It's basically a full-time job for a whole department.
Easily. The technical challenge of just generating an accurate country-by-country report is a multi-million-dollar annual expense for these Tier 3 companies.
But why force them to do this? What is the core objective of this third tier?
Absolute, undeniable transparency. The Dutch tax authorities and their international counterparts with whom this data is automatically shared via tax treaties, they want to instantly see the misalignments in a standardized, machine-readable format.
So it's an automated mechanism for spotting inconsistencies.
Exactly. It's an algorithmic red flag generator. Think about it. If a company reports having 10,000 employees and massive tangible assets in the Netherlands, but only reports 1 million euros in profit, while simultaneously reporting 0 employees, 0 tangible assets, and 1 billion euros in profit in a zero-tax jurisdiction, the country-by-country report waves a giant red flag.
Because it just doesn't add up.
Right. It exposes the artificial shifting of profits brilliantly and quantitatively. The authorities don't even have to audit you to see the anomaly. It's handed to them on a spreadsheet.
That is wild. So having all these files, the functional analyses for Tier 1, the master files and local files for Tier 2, the massive global data consolidation of country-by-country reporting for Tier 3, that is a monumental administrative task.
Undeniably.
But as the text makes very, very clear, merely having the data isn't enough. It's about when you have them prepared and what happens to your company if you don't have them perfectly ready when the watchdog comes knocking. This is where the real danger, the existential threat, lies for a corporation.
Absolutely. The timing of this documentation is governed by a strict legal principle known as the contemporaneous requirement.
Contemporaneous, meaning happening at the same time.
Correct. The law dictates that your transfer pricing documentation must be prepared contemporaneously with the transactions themselves. Practically, under Dutch law, this means your master file and your local file must be fully completed, finalized, and sitting within your company's administration by the exact deadline for filing your annual Dutch corporate income tax return.
Okay, so it's exactly like doing your homework in school. You have to do all this complex economic benchmarking, write up the global supply chain, analyze all your intercompany invoices, and put it all perfectly into a folder in your backpack.
Yes.
You have to have it completely finished and ready to go by the day the tax return is due, even if the teacher, in this case, the Dutch tax authorities, doesn't explicitly ask to collect the homework that day.
That is exactly how the submission protocol works, and it's a trap many companies fall into. The text clarifies that companies do not proactively submit their master local files as attachments alongside their annual tax return.
So you don't upload them to a government portal every year?
No, they just sit quietly in your corporate administration. Because they aren't proactively submitted, many CFOs think, why spend 50,000 euros on an economic benchmarking study this year? Let's just wait and see if we get audited. If we get audited, we'll hire the economists then.
Well, I mean, that sounds like a pragmatic, cost-saving business decision.
It is a fatal error.
Really?
Because if the Dutch tax authorities initiate an inspection or a formal audit, and they request to see those files, the clock starts ticking incredibly fast.
The text highlights a terrifying window for this, 14 to 30 days.
Yes. Upon request, you typically have only 14 to 30 days to produce these incredibly complex, highly detailed files. If you haven't prepared them contemporaneously, if your backpack is empty when the inspector asks for your homework, you are in massive trouble.
But wait, why can't you just rush it? Hire a massive consulting firm and throw money at the problem to get it done in 2 weeks.
Because it is virtually impossible to reconstruct a legally defensible master and local file from scratch within that window.
Just too much work.
It's too much. You're talking about analyzing a year's worth of global data, conducting database searches for comparables, interviewing local managers for the functional analysis, and drafting a 50-page economic report. You cannot do it in 14 days. You will submit an incomplete, rushed, or deeply flawed document.
So what does this all mean? What is the actual tangible penalty if the auditor asks for your backpack and the homework isn't in there, or it's clearly thrown together at the last minute and deemed inadequate?
This brings us to what I think is the most high-stakes, ruthless legal mechanism in this entire text.
The legal trapdoor of the burden of proof.
Yes, this is the moment where the power dynamic in an audit completely shifts against the taxpayer. Normally, under standard administrative and tax law principles, the authorities bear the burden of proof. There's a presumption of innocence, essentially.
Like in a criminal trial.
Exactly. If the tax office looks at your return and thinks your transfer pricing is wrong, say they think you overcharged your Amsterdam office for that German software to artificially drain profits, the tax office has to build the case.
They have to do the math.
Precisely. The tax inspector has to find the comparables, they have to run the economic models, and they have to mathematically and legally prove that your pricing is fraudulent or incorrect.
But what if your documentation is missing?
If your required transfer pricing documentation is missing, submitted past the deadline, or deemed wholly inadequate during an audit, a specific legal mechanism triggers the reversal of the burden of proof.
A total reversal.
The legal onus shifts entirely away from the government and lands squarely on the shoulders of the corporation. The tax office no longer has to prove your pricing is wrong. The tax inspector can simply look at your business, make an educated guess, and state, We believe your taxable profit in the Netherlands should be 10 million euros higher. They issue an assessment for the taxes owed on that 10 million. It is now entirely up to you, the taxpayer, to mathematically and legally prove that their arbitrary assessment is wrong and that your original numbers are right.
And if we analyze that defensive position, I mean, it sounds nearly impossible. You were already starting from a position of failure because you didn't have the documentation in the first place, which is why the burden reversed.
Exactly.
Now you're scrambling to prove a negative that the government's guess is wrong against a fully empowered government agency that has just handed you a massive bill.
It is a profoundly difficult and defensive position to maintain. When the burden of proof reverses, you are fighting an uphill battle in a snowstorm.
What a visual.
The Dutch tax authorities have tremendous leverage at that point. You are effectively guilty until proven innocent, and proving your innocence in transfer pricing requires the very documentation you failed to produce in the first place.
It's a closed loop of liability.
It is. Effectively, a lack of paperwork failing to follow the contemporaneous requirement can instantly lose a company a multi-million euro tax dispute before the actual economics of the transaction are even fully debated. The procedural failure becomes a catastrophic financial failure. Companies often settle for massive amounts just to end the pain of trying to disprove the tax authority's assessment.
It is a staggering consequence for bad administration. You aren't being punished for shifting profits. You're being punished for not having the paperwork to prove you didn't shift profits.
That's a great way to put it.
But for the biggest companies in the world, those in the Tier 3 category, with over 750 million euros in global revenue, the stakes go even higher than just surviving a local audit in Amsterdam or managing the burden of proof, right? Our source material points to a massive, overarching new framework that completely changes the endgame of transfer pricing. We are talking about Pillar 2.
Yes. If we connect everything we've discussed so far to the absolute cutting edge of international tax law, Pillar 2 is the new reality for megacorporations. It is the most significant change to global taxation in a century.
A century.
Easily. The guide explicitly mentions that the global minimum tax framework, known internationally as Pillar 2, is fully active in the Netherlands.
So this isn't just a proposal at the OECD. It is live, enforceable law on the books in the Netherlands today.
It is live. And to understand why it's prominently featured in a guide about transfer pricing, we have to look at the deep mechanical interplay between transfer pricing rules and Pillar 2 calculations.
Because historically, as we discussed at the very beginning of this deep dive, the whole point of aggressive transfer pricing was to shift profits out of places like Amsterdam and funnel them into tax havens where the corporate tax rate might be 0% or 5%. The goal was to drive the company's overall global tax bill down to the floor.
Exactly. A company's transfer pricing strategy directly feeds into their calculations of their effective tax rate, or ETR, in any given jurisdiction.
Right.
If you use internal pricing to shift all your Dutch profit to a subsidiary in a Caribbean tax haven, your effective tax rate in that haven is essentially zero. But Pillar 2 fundamentally breaks that strategy.
How so?
The global minimum tax framework dictates that these massive corporate groups, the ones over 750 million, must pay a minimum effective tax rate of 15% on their profits, regardless of where in the world those profits are booked.
Wait, so if a company successfully uses transfer pricing to shift 100 million euros in profit from Amsterdam to a tax haven with a 0% rate, how does the Netherlands actually enforce a tax on profits sitting in another sovereign country? They can't just send a tax bill to the Caribbean.
They enforce it through a mechanism called top-up taxes.
Top-up taxes.
Yeah, if a multinational corporation uses aggressive transfer pricing to shift profits out of the Netherlands and into a low-tax jurisdiction, and their calculated effective tax rate in that low-tax jurisdiction drops below the 15% global minimum.
Let's do the math on this to make it concrete. Let's say a company shifts profits to a jurisdiction that does have some tax, but it's very low. Let's say after all the transfer pricing maneuvers, their effective tax rate in that jurisdiction drops to 4%.
Okay. If it drops 4%, the Pillar 2 framework is immediately triggered. The Dutch tax authorities, or the tax authorities in the parent company's home country, depending on the specific corporate structure, are legally empowered to apply a top-up tax.
Okay.
They will calculate the mathematical difference between the 4% the company actually paid in that jurisdiction and the 15% global minimum.
Which is an 11% gap.
Exactly. They will then levy a top-up tax on the corporate entity in their jurisdiction to collect that missing 11%.
Meaning the company is forced to pay the 15%, regardless of how clever their transfer pricing strategy was?
Exactly. The top-up tax effectively neutralizes the primary benefit of shifting the profits in the first place. You can move the money on paper using all the transfer pricing tricks you want. You can use the CUP method, the TNMM method. You can build the most beautiful master and local files in the world. But Pillar 2 acts as a massive global safety net underneath the entire system. It ensures the corporation pays at least a 15% tax on those profits somewhere in the world.
It makes the aggressive manipulation we talked about in the beginning almost entirely pointless for the biggest players. Why spend millions on economists to justify shifting profits to a 4% jurisdiction if the Dutch are just going to hit you with an 11% top-up tax anyway?
Exactly. It forces companies to focus on operational reality rather than tax arbitrage.
It's a fascinating evolution of the rules. Well, let's take a moment to recap the incredible journey we've just been on. We started by understanding the fundamental paradox of transfer pricing, trying to enforce natural market rules in an internal corporate structure completely devoid of market forces. We explored how the Netherlands anchors its system and the OECD's arm's length principle via Article 8b, legally requiring companies to act like strangers and utilize standardized pricing methodologies like the comparable uncontrolled price or the transactional net margin method.
A toolkit.
Exactly. We then scaled up the complexity, moving from the basic functional analysis of Tier 1 to the rigorous, highly structured master and local files of Tier 2, all the way to the granular global transparency demanded by country-by-country reporting for the Tier 3 giants.
A lot of paperwork.
So much paperwork. We highlighted the critical danger of the 14 to 30-day audit window, the necessity of contemporaneous documentation, and the terrifying legal reality of the reversal of the burden of proof. And finally, we saw how the new Pillar 2 global minimum tax acts as an overarching umbrella, catching the profits that transfer pricing tries to hide through top-up taxes.
It is a remarkably intricate, interconnected system.
That really is.
But looking at everything we've unpacked, especially regarding Tier 3, there's a massive implication that extends far beyond the tax code. Yeah, we talked extensively about how these massive multinational groups are now forced through country-by-country reporting to expose their global income, their precise headcount, and the exact taxes they pay in every single jurisdiction around the world.
Right.
Right now, that massive trove of data is sitting securely in the hands of the tax authorities. But as history and the digital age show us repeatedly, data rarely stays perfectly contained forever.
That is very true.
How long will it be before this extreme level of corporate tax transparency inevitably leaks out of the closed doors of the Dutch tax authorities and the global financial system?
Oh, wow.
And when it does leak, when the public, journalists, and activists can easily see on a single leaked spreadsheet exactly which beloved global brands are starving local economies while hoarding billions in zero tax havens with zero employees, how fundamentally will that raw data alter consumer behavior, public perception, and brand loyalty across the globe? It's not just an accounting issue anymore. It becomes a profound question of corporate reputation and social responsibility.
A completely different kind of accounting. Thank you so much for joining us on this deep dive for you today. Keep questioning the systems around you, keep looking for the hidden rules of the game, and we will see you next time.
Thank you for listening to Reporting Matters. Before we go, please note that this discussion is for informational and educational purposes only. Nothing stated in this episode constitutes investment, legal, financial, accounting, or tax advice, nor does it replace the professional judgment of a qualified human professional. Reporting Matters endeavors to ensure the quality of its content, but AI systems can generate inaccuracies. We make no warranties regarding the completeness, timeliness, or accuracy of this information. Listeners should conduct their own independent research and consult a certified financial professional before making any financial or investment decisions.